Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Chris Dearborn. He's the Managing Director of the Nasdaq Markets Intelligence Desk, and we are celebrating Chinese New Year together. So happy New Year to everyone that's celebrating that. But Chris, we're going to talk about a really interesting statistic, because that's what we love to look at, following the markets. But the year of the dog is an investor's best friend. Of all the zodiac signs, the dog sports the best average return. So take a look at this chart here. This is courtesy of Ryan Dietrich. He's a senior market strategist at LPL Financial Research, one of my favorite macro analysts that are out there. And what he did is he took a look at the return of the S&P 500 starting in late January, dating all the way back to 1950. And that shows the year of the dog is up more than 15% on average. So as Ryan said in his report, woof indeed. It really has been quite a market in the last 2 weeks, especially.
Especially, I mean, you've seen a January where we made record highs across the board, and all the major indexes, S&P 500 absolutely included in that, and that was right at the end of January. Then you saw February come, and you saw the market sell off so much so that people were talking, we had a correction of a 10% decline in all the major indexes. Volume picked up to an unprecedented amount. You're talking an average of 6.5 billion shares was the one-year average. We're doing almost double that every day, that 1 week in February, and here we are. Coming into expiration.
Expiration week, there's been one direction.
And straight up, we got, depending
on
how things,
what's happening
we're
now.
kind of flat. Volume's a little bit light right now. We're at about 5 billion shares of consolidated tape. We're hoping to get to about 6.5, which will be average. Maybe the close today with the option expiration will add to that a little bit. We'll see what happens. But I think everyone's just taking a big breath. Right now, the S&P's up about 2-ish% for the year. You know, still a great start.
Considering we were down, we had a 10% correction in the Dow last week, right? And the S&P 500 is on track for its best week since January 2013. I'm just trying to wrap my head around that momentum. It was quite incredible this week.
The movements today have been significant, as they have been all week. You're seeing a lot of volatility back into the market, which is great for traders. You know, highs and lows, intradays moving back and forth. Really, the direction's been set towards the end of the day. You're never really sure which way it's been going to go, but it seems to be like a weekly basis. Last week was one of the worst weeks performance in the market for the last 2 years, and this week's on track to be one of the best in over 3 years.
Yep, well, even the Nasdaq comp, it's a best trading week if we stay on course through the close today since December 2011. The natural question is this upward momentum sustainable? Because I feel like traders hated the past rally we saw over the past 18 months, right? They are hating it this week.
They finally have. They got the volatility back in the market. So you have high volume, and you're hoping this kind of continues to a point. So what you're looking at really is some fundamentals that are here. Earnings have been, for the most part, still relatively good. You have a number of large cap companies that have been reporting. They kind of are the larger participants of these indexes. You know, the big boys will pull the indexes along with them depending on where they're going, and the mid cap and small cap names kind of get pulled along for the ride. And you've had some significant moves. You had Amazon again yesterday making another all-time high. So you've got some large cap names that are listed here on Nasdaq that are really just kind of moving the cycle forward. And with that, you've got underlying economic data, right? We have PPI, you have CPI, with, you know, which was a hot number the other day.
Well, that was so interesting, the reaction, right? The futures totally tanked just to open up and have a super strong close yesterday. And I feel like this kind of reminds me like we're in the middle of this bull rally where good news was bad news for the tape and vice versa. Because okay, look, CPI is good, PPI is good, we're almost at full employment, corporate earnings are good. That sounds good for the economy, but it's interesting to see how the market reacts to it, but to see how the futures were down so significantly with the CPI number only to recover to the way that it traded yesterday. That's what makes you question, is this momentum sustainable?
It really is. So what you've seen here is that check mark box, right? People are still buying the dip. They're letting the dip come to them a little bit more, especially with last week. People got a little uncertain, especially when you had multiple sell-offs one day after another, and the intraday moves were wild. So what you had there was people kind of waiting for that dip. Now that's kind of settled down a little bit. The volume has kind of really,
it's kind of
25,
back 30% to where it was.
Less. Well, we're close, right? Today will be day. You know, we're averaging about 8 billion shares consolidated tape this week. The week before, you're averaging almost 11. You know, that's double. We had 1 day, 2 days we did north of 12. You know, the volume on that scale is showing you that you have traders in the market, you have day traders go back and forth, market makers are participating, but where are the institutional buyers and where's the plain vanilla money? And they're still there buying the dips. They're just waiting to see how much of a dip they want to get, because we've come so far, so fast in the last 6 months. And you really need, like we said in the past multiple times, since the presidential election, the market has been on a tear. And even before that, since the financial crisis, the market has done very well. So what you're looking at here is are we done? Are we taking a pause or a breath? And you can some people can make a comment that, we can go higher, just like we did at LPL. There's, 15% would be a great return this year for the S&P 500. And what you've seen, you have the volatility with the VIX remaining below 20 right now, is that go back to 14, and then you have that steady baby step climb up. Because remember, the markets will move up on baby steps, but they will sell off on, or rip your face off, as we say.
Which is typical up until this week. It's
Right.
crazy that you're down almost 2,000 points, and then you're just about what?
Yep.
Like we're about 70% recovered from there?
Pretty much.
So.
I mean, for the year to date, 2% move plus, considering where we were, 2.2 for the Dow, I think 2.2 for the composite, give or take. You've seen a great move up, and I think what you have is you're working through the excess supply of the people who were the traders who bought the stock on the volatility, who are working on that, and the fundamental money is going to continue to flow back in, whether it's from pension funds or others that have to put money to work, and then the ETFs are going to be putting money to work as well as those indexes continue to move higher, pulling up the investors that are willing that, and that money continues to get put to work, and the large cap names will be the beneficiary there.
All right. Well, thank you very much for joining us. And traders, thank you for joining me throughout the week. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.